Hello, everybody. Welcome everyone to our webinar. And also welcome to those that are viewing our recording later on YouTube. We're glad you're here. We're really excited to present today's topic for the 2023 tax law changes that you need to know. I'd like to present everyone on the panel today. My name is Angie O'Day. I'm the Client Success Manager here. And then we also have David Auer, the owner and founder of our firm, and then Elliott Barber, who is a part of our tax team. So let's go over our agenda. It's going to be really great. We have, first of all, we're going to cover inflation reduction, the Inflation Reduction Act. Next, the Consolidated Appropriations Act, other odds and ends, and then the important 2023 tax numbers. And lastly, the importance of proactive tax planning.
Thanks, Angie. So I'll just start off with a disclaimer that none of the recommendations today or examples are intended to impose any kind of penalty under the Internal Revenue Code. Clearly, if you're going to take any action on the items that are, or the ideas that are talked today, we'd recommend seeking good tax counsel. So I'm going to have Elliott start off with reviewing a very important piece of legislation that passed last year, which is the Inflation Reduction Act of 2022.
Thanks, David. So yeah, first I'll cover the Inflation Reduction Act of 2022. And first and foremost, this is a recap of a webinar that we broadcast in September of 2022, titled the $80 billion question. So of course, our main focus in the Inflation Reduction Act is just how the Department of Treasury will allocate their new influx of funding. So that said, let's start with a recap. So by way of background, the House and Senate each passed a version of this bill with only Democrat support. No Republican in either house voted in favor of the bill. In general, the bill is sort of based on like aspects of like the Build Back Better, the Green New Deal, but a lot of like those aggressive spending provisions were sort of stripped away through the negotiations among the Democrats. You might remember like Joe Manchin sitting on the back, the stern of his yacht, sort of getting talked at from constituents and saying he wasn't going to agree to the main Democratic points of views. So again, that title might be a bit of a misnomer. Inflation is caused by too much money chasing too few supplies. So next slide. So in this bill, there are a lot of credits in renewables and clean transport that affect, and that may like result in more inflationary pressure. So again, it's more money chasing fewer supplies. So if you have more credits, you're getting more money chasing fewer supplies. So as we have these new credits, we also have the Medicare prescription drug prices are now negotiable. And although this will reduce the price and save us a lot of money, again, it's more money in the market chasing fewer supplies. So one thing many of us want to spend a lot of money on are like these green investments. Well, the Inflation Reduction Act promotes spending on EVs through a $7,500 tax credit for purchasing EV vehicles under $80,000. So, of course, when these rules were promulgated, what did the automakers do? They raised their prices by $7,500, or they priced their vehicles just at $80,000. So again, inflation kind of promoted a little. Another investment that a lot of us might want to look into are like solar panels. In general, the average house might require about $100,000 of solar panels to kind of cover the average roof in the United States. And even in the least sunny state in the United States, that'd be enough solar potential to sort of cover energy consumption by about a factor of 2. So it's more than enough energy. And if you put this amount of solar panels on your house, about $100,000, you get a 30% dollar for dollar tax credit. And if you do this and you own a business, you can deduct about $85,000 over the next 5 years using Maker's depreciation schedule. Or you could take an 80% bonus depreciation if you place the panels in service in this year. So it's a fairly aggressive plan to get you to go out and spend, but again, it doesn't necessarily reduce inflation. One other aspect of the Inflation Reduction Act is that the excess business loss limitations as promulgated in the Tax Cut and Jobs Act have been extended through the tax year of 2027. So these are the rules in the Tax Cut and Jobs Act that prevent you from deducting business losses in excess of $500,000 against your ordinary income that would be greater than that threshold. So, for example, if you're a doctor and you have W-2 income of about $800,000 and your spouse is involved in commercial real estate and generates a $2 million loss, you would still be responsible for $300,000 of income. And this is why we try to stress that you should really look to get 1099 income instead of W-2, because it takes back kind of that control over how your income is taxed. Slide. So one of the aspects of another aspect is that we want to talk about this new and improved IRS, kind of getting back to the meat of what our September 2022 webinar was about. So in 2019, 92% of all audits occurred on those with income below $200,000. Treasury Secretary Yellen has explicitly stated that audit rate will not go up. So we're not going to take the enforcement money that we'll have and spend more time auditing people under $200,000. That said, the IRS can't just take this $80 billion and throw it right into enforcement. They can't. One, there's not enough people that are qualified to do the work. And two, the IRS is operating on 50-year-old machinery. They need a lot of investment in a lot of places. In 2021, the taxpayer advocate only responded to 11% of phone calls that they received. And the taxpayer advocate works for us. It works for you, works for me. They don't necessarily work for the IRS, though they're paid by them. They're there to help us solve our problems. And if they can't answer more than 11% of phone calls, it makes it very difficult for us to get problems. So Secretary Yellen has stated that she has 4 priorities. First, clear the backlog by the end of 2022, which it's later than that. Hopefully they have. Second, she wants to hire customer service people. Hopefully that taxpayer advocate can answer more phone calls. Third, she wants to overhaul technology. As I said, they're operating on 50-year-old machines. And fourth, she needs to replace 50,000 IRS employees that are set to retire in the next 5 years. So all that talk about 87,000 new tax enforcement agents, that may be a bit blown out of proportion, but there's certainly going to be an increase in enforcement. As you can see, about more than half the money is going into enforcement. So our next slide shows the way funding will change after this law goes into effect compared to the previous 10 years. As you can see, there's a significant influx of money into the various parts of the IRS, and they're really going to need to do this because they've been operating at 12% fewer employees that they had just a decade ago. And if you'd like to learn more about the Inflation Reduction Act and IRS audit red flags and some other points that we made, please check out our webinar on physiciantaxadvisor.com. Under our webinar section, it's titled the $80 billion question. Now, David's going to provide a summary of the Consolidated Appropriations Act of 2023, including the Secure 2.0 Act. David.
Great. Thanks, Elliott. Yeah. So one of the things that we shared in the September webinar was, the statistics of the IRS over the last 10 years and what type of condition they're in currently. And it was pretty eye-opening in terms of how the IRS has really been downsizing unintentionally, but they just haven't been able to find qualified people to come in. So this is a 10-year game plan for them. The idea being is they improve their customer service response, as quickly as possible, improve technology. That's going to take a while, a little bit of time just because of like Elliott said, how many years behind they are. I read in one place or one source that they're still working on COBOL and Fortran computer programming, which were products of the 1970s and 80s. And they're working on, in today's value or dollars, a 1973 budget. So this new money will allow them to hopefully get back to a plain level field. The enforcement side of it is the one that I think draws the most attention because a lot of the things that have been written about this bill or how many more IRS auditors there's going to be. There will be more IRS auditors. Hopefully, they take a while to get trained. Also, they're struggling with the supply and demand and availability of people out there. Right now, there's less than a 1% unemployment rate in the accounting profession, so it's going to be difficult for them to hire competitively qualified people that they can then train to conduct audits. So I do believe that there'll be a shift more toward the higher income taxpayers that will get most of the attention. $400,000 of taxable income and above is what I would think is their in their bullseye. But I don't think anything will happen in relatively soon. I think it's going to be toward the end of that 10-year time period. So again, if you are interested in learning more about how to audit proof your tax return, we do talk about that also in the September webinar, and it is available on our website, physiciantaxsolutions.com. So moving to the next bill. So this actually didn't quite draw the attention that the Inflation Reduction Act did back in August. So this bill was signed at the end of December, December the 29th. It included another act or bill that was the Secure 2.0 Act of 2022. Basically, most of the changes, and what we're going to focus on today, are most of the changes that deal with retirement plans. So one change was they are bumping back the required minimum distribution age, which is when you have to start taking money out of your tax-deferred retirement account. There'll be an automatic enrollment. So rather than people electing to be part of a retirement plan, now they will be required to be a part of the retirement plan unless they opt out. There will be larger catch-up contributions available for older participants. The penalties for not making your required minimum distribution payments on time will be reduced. And then there's a new feature for families that have 529 plans for their children that will allow any unused 529 plans to be converted or rolled over tax-free to Roth IRAs for the benefit of that child. So this bill, like I mentioned, was signed at the end of December. Had $1.7 trillion spending included in it. The majority of these changes in the Secure 2.0 area or bill will be phased out in over several years, much like the Tax and Jobs Cut Act back in 2017, which had a 10-year phase in. And I'll go over some of the changes that are coming up later in the presentation that are happening on an annual basis. And like I mentioned, for the most part, we're going to focus on what's called Division T of that Secure 2.0 Act, which is the areas that are impacting retirement plans. So I'm going to go through this somewhat chronologically, just give you the highlights of the changes as they occur each year. So starting this year, like I mentioned, the required minimum distribution age goes from 72 to 73 this year, and it'll go up to 75 in 10 years in the year 2033. The penalty, if you miss your making your timely required minimum distributions, it was 25%. That's going to go down to 10% if you fix that distribution within 2 years. A couple of I think a lot of these changes are positive for the retirement plan community and participants. You will also have if an employer. And again, a lot of these changes have to require that an existing plan gets amended to add these provisions. But the new law now allows the employer matching and the non-elective contributions that are made to a 401k, 403b, and or a 457 plan. You can designate those as Roth contributions. The prior law was they were required to be tax deferred or tax deductible contributions, but you can designate as a participant that you'd like those to be in a Roth form. The only contingency is that the employee has to be 100% vested when that money is contributed. They added another rule or allowance that allows employers to incentivize their employees to make deferrals. So such a small, you can, as long as the gifts are not substantial, but small gifts like gift cards as an example are allowable. The law also allows now for simple IRAs and SEP IRAs to be designated as Roths. Previously, they were only the only option was a tax deferred, and you can still make a distribution directly from your IRA to a charity of up to $100,000 a year. So that rule had lapsed at the end of 2022. So that now is extended. Also, again, starting this year, you can, up to certain amounts, you can take out penalty-free distributions to reimburse you for qualified birth, adoption, and or in cases of being a victim of domestic abuse. Starting next year, the new change will be that you would no longer be required to take required minimum distributions from Roth 401ks and Roth 403bs. In the past, you would have had to have rolled that Roth 401k or 403b over to a Roth IRA in order to avoid the RMD rule. So they avoided you having to now take that extra step. And now Roth 401ks and Roth 403bs are now excluded from the RMD requirement or calculation. Catch-up provisions that are made to 401ks, 403bs, 457 plans, only if you're for employees that are paid over $145,000 a year, and that number will be indexed for inflation. Those are required now to be Roth contributions, no longer for a highly compensated employee considered, which is 145,000 or more. Those catch-up provisions are now, you can't put them in a tax-deferred account. They have to go into a Roth account. So basically, after tax dollars, a lot of these are geared to generate tax revenue for the government today. In exchange, the government's willing to give up the tax that they would have collected had that money been stayed in a tax-deferred account. Another interesting change to this bill, again, or this law that again doesn't start until next year, is that if you have a student loan payment that you are paying off, and again, if your employer has this added allowance in the plan, your student loan payments that you make during the year are deemed to be salary deferrals in a 401k, 403b, or 457 plan, which then allows the employer to then match the equivalent of what you're paying down in student loan debt as if it had been a salary deferral. So that's a new change that's going to be very valuable to a lot of our younger physicians who have student loan debt, and they're trying to pay those off without and not able to take advantage of a 401k or 403b. So that'll definitely mitigate or make that a little bit easier for them to at least get the employer match contribution. There's a small allowance in the event of emergency. If you need take money out of retirement plan up to $1,000, the 10% penalty will not apply to that. You do have to repay it back within 3 years, and until you repay it, you can't borrow. It's not an annual amount. It's basically a total amount of $1,000 at any one time. Can't be taken out of the plan in total. Also, in the year 2024. For 401ks, 403bs, 457 can allow a non-highly compensated employee to defer up to the lesser of 3% of compensation, or $2,500 above and beyond their normal deferral, and this money would be set aside in what's described as an emergency savings account. So it's a way for non-highly compensated employees to go above and beyond the normal limit on how much they can defer out of their salary into a traditional 401k or 403b plan. And then another benefit, like I mentioned earlier when I highlighted it, is that if you have a child who has an unused 529 plan, i.e. they got scholarships, or they ended up not going to college or not needing all the money to spend, as long as that 529 plan has been in existence for at least 15 years, as of 2024, you can roll over any unused money, and it may take a couple of years to do this, but up to whatever that year's Roth IRA contribution amount is, and you can roll that into a Roth IRA for the plan beneficiary, the 529 plan beneficiary, and it's tax-free as long as contributions to the 529 plan had not been made in the last 5 years. So you got to meet those conditions, but at least there is an exit strategy for a lot of people who have unused 529 plans. The alternative is that money comes out taxable to the as income to the growth taxable to the beneficiary in the year that money is taken out of the 529 plan that otherwise isn't spent on education. Starting in the year 2024, so again, this doesn't kick in until next year, the catch-up contributions for 401ks, 403bs plans will go from the current $7,500 to $10,000 a year. If you have a simple plan, that catch-up contribution will be increased to $5,000 a year. Again, it'll be indexed for inflation each year, and it's available only for participants between the age of 60 and 63. So it's just a small group of taxpayers. If you're not yet, so normally you have catch-up contributions that once you're over 49 years old, and so you're subject to that the existing catch-up rule if you're not yet 60. And then if you're over 63, it drops back down to that smaller amount. So only that window of 60 to 63 is that catch-up allowance increased. Again, just a lot of these new rules have some conditions and requirements before you become eligible. So again, make sure you know what the rules are before you'll take action on any of these plans or these rules. Also effective in the year 2025. This is where there's going to be on all new retirement plans that were set up after December 29th of last year, the date the bill was effective. Every plan that's set up will automatically enroll all of its eligible employees, and the employer is required, and the employee will be required to contribute. So this is coming out of the employee's pocket, a minimum of 3%. If they want to, they can go all the way up to 10%, unless that employee opts out. So there'll be an automatic enrollment. This is the intent of this law is to get more employees to sign up rather than opt in. You now have to opt out of a retirement plan offered by your employer. So that'll be, and then that 3% amount will be increased by 1% each year after that. So that, so again, if your employee can't afford to defer some of their salary into a 401k, they'll need to be aware that they're going to need to opt out of that. Otherwise, it'll be taken out of their salary and contributed to that plan. A new change also starting in 2025 is that you can use your retirement plan penalty free up to and pay your long-term care insurance premiums up to $2,500 a year. So that's a new change as it relates to being able to pay long-term care insurance. Before, that would have been a taxable distribution, subject to the 10% penalty if you weren't at least 59 and a half. And then lastly, starting in 2027, lower income employees will be eligible for a new federal matching contribution of 50% of their contribution into retirement savings of up to $2,000 a year. So the federal government will give up to $1,000 if the employee contributes $2,000 into these low income or lower income retirement plans. And again, where that may come in, is with some of your other employees that are your lower income employees that do want to save. This may be a better opportunity for them to accumulate savings than a traditional, matching of a 401k plan. They're getting basically a 50% match. So that's a pretty good deal for lower income employees. What I'd like to then talk about is what are some special tax credits that are now going to be part of the law under the Secure Act. So as of right now, there's two credits that relate to retirement plans. One is the startup credit. So these are for the costs of setting up a retirement plan. So certain employers, so these are employers that have less than 50 employees, and they have at least one non-highly compensated eligible employee. So that is defined as someone who makes less than $100,000 a year in wages. The credit is equal to 100% of the qualified startup costs up to $5,000. If for employers that have between 51 and 100 employees, so there is no credit for over 100 employees for employers, the existing 50% credits remains unchanged. So the law right now is a 50% credit. It now becomes in 2023, if you have fewer than 50 employees and one non-highly compensated eligible employee, it now is a 100% credit. So a nice improvement there for those who have created a new retirement plan. The credit applies to qualified plans. Those are defined contribution plans such as profit sharing plans, thrift plans, that are as well as a 401k, 403bs. SEPs and simples. However, this credit does not apply to defined benefit plans. Defined benefit plans are actually generally one of the more expensive plans to set up because of the actuarial calculations that have to be made. But unfortunately, the credit does not apply to the defined benefit plans, which are unfortunately because it's the most expensive plan. The way the credit formula works, it's the lesser of 100% of the qualified startup costs, like I mentioned in the last slide, or the greater of $500 or how many number of non-highly compensated employees you have. So as you can see here, if you have 20 or more employees, you are going to get the full $5,000 credit. I have an example here just to walk through, how that calculation works. So in this case, ABC Company started a plan in 2023, incurred a cost of $4,200 to set it up. They have 40 employees, 36 of who are non-highly compensated. Under this new law, the credit would be the lesser of their startup cost, which is $4,200 or $5,000. Because the employer has more than 20 employees, like I showed on that previous slide, they would receive a potential credit of $250 for each of the first 20 employees. Since their startup costs, however, since their startup costs are less than the $5,000, the credit's limited to that $4,200 amount. But at least they got made whole in the form of a credit. Now, obviously, as you are well aware, a credit is a lot more valuable than a deduction. A credit is a dollar for dollar offset to whatever that cost is that's being incurred. There's also a credit for contributing to a retirement plan on behalf of your employees. So this credit is 100% of the eligible contributions that are made by the employer for each employee, up to $1,000 per employee. It's 100% for the first year and the second year. It's reduced to 75% in the third year, 50% in the fourth, 25% in the fifth, and then is no longer eligible for a credit after the fifth year. The full credit's available for employers with 50 or fewer employees. Again, this is for smaller companies. It's phased out for employers with 51 to 100 employees. Specifically, the way the calculation's made on how it's reduced, it's equal to about 2% of each employee in excess of 50 employees in the prior year. So I'll walk you through an example of this. Let's say XYZ company has 56 employees, so they're over that 50 threshold. So that means they're going to get some kind of a reduction the year before establishing the plan. So employees all make under 100,000, so none of them are highly compensated, and the company makes a $1,500 contribution for each employee. So calculating the contribution credit, you'd multiply the 56 employees by the $1,000 maximum credit. That gives you a starting point of 56,000. However, since they have over 50 employees, they'll need to reduce that credit. So the way that's calculated is they take those 6 employees that are over 50 by 2% for a total of 12%. So now XYZ company then multiplies the 56,000 by the 12% to determine the amount that the credit would be reduced. In this case, it would equal to $6,720. So this means that the credit for year one would be $49,280. Still not a bad deal, because basically the employer, assuming that they were otherwise going to make a contribution of $1,500 per employee, they're getting a very significant credit back on their tax return that offsets a big part of what that employer is contributing. So this is a really nice benefit that we haven't had in the past for employers that are generous enough to make contributions on behalf of employees to qualified plans. And again, assuming the numbers of the employees stay the same, the credit would be the same in the second year. Then it would be reduced down to 75%, 50%, and 25% then through years 3 through 5, and then would be eliminated in year 6. So that covers the examples of or the main highlights of the Secure Act of 2.0 of 2022. Certainly for those of you who have retirement plans that have some of these features that you can add to the plan, encourage your employer, or if you're an employer, talk to your third-party administration firm about adding these provisions as they become law to your plan to the extent that you want to incorporate them. I'm next going to shift to some of the other changes that have happened this year versus last year. So what I've done here is list a series of numbers, relevant numbers that have something to do with your tax return possibly. So first is standard deductions. So they went up for each of the filing classes from 2022 to 2023. The alternative minimum tax exemption also went up gradually. I'm not sure if it really reflects the increase in inflation, but it did go up from 2022. The amount that you could contribute to an IRA if you're under age 50 went up $500. And the same with the if you're over. I'm sorry. It went up, and then if you're over age 50, it's in parentheses what the max is. So that went up by $500. The 401k limit went up by $2,000 if you're under age, or if you're under age 50, $1,000 if you're over age 50. How much you could contribute between your 401k and your profit sharing plan or your SEP went from 61,000 to 66,000. And again, with the catch-up provision being in the parentheses amount, flexible spending accounts went from $2,850 to $3,050, as well as the HSA contribution amounts went up. Again, you have until April 15th to contribute to your health savings account if you haven't already for the year 2022. The earned income tax credit went from $69.35 to $74.30. The estate tax exemption, which is scheduled to phase out or back down to its original amount of $5 million, or actually that, I don't know if that's been determined yet, but right now it's for each individual, you can either gift and or have an estate of $12,920,000 before you have a federal estate tax. And the annual gift tax exclusion, so this is the de minimis amount that you can gift to an individual, went from $16,000 to $17,000 before. Anything over that you gift would then erode part of your unified credit or your estate tax exemption. And then the amount, the maximum amount that you can expense under Section 179 also went up by $80,000 or $190,000, depending on which level you're in of a business. Other odds and ends that I want to just talk about, and this is the timeline, still the leftover effects of the Tax Cut and Jobs Act. So starting this year, or starting last year, I'm sorry, in January, as some of you may have found out the hard way, the research and development expense that usually was prior to 2022 could be 100% expensed in the year incurred. The new rule as of January of last year was it has to be capitalized and depreciated out over a 5-year time period. We were hoping that the bill that passed in December would retroactively extend the 100% expense, but it didn't happen. And unfortunately, that has been adversely affected a lot of companies that have significant research and development. The deduction for business interest is limited to 30% of earnings before interest and taxes. So that limitation, so there is a cap now on how much interest expense you can deduct. Starting this year, bonus depreciation, which has been a very popular deduction in lieu of claiming a 179 expense, was 100% last year. Now it's down to 80% of whatever capitalized costs you have that are otherwise eligible for bonus depreciation. The remaining 20% now is depreciated out over whatever the useful life of that asset is. That's going to gradually be phased out all the way down to zero at the end of 2026. And then fast forward to January 2026, again, Congress can change any of these in between now and then, but as of right now, a lot of this was back as part of the Tax Cuts and Jobs Acts in order to provide the tax benefits during the 9 years. Generally in the 10th year, there had to be a makeup provision to be able to make the tax bill neutral from a cost standpoint. So the individual tax reductions rates that have been in effect will go away. And then in 2026, we'll have the top tax bracket of 39.6 come back in effect. There'll be the standard deduction will go back down to a smaller amount, and we'll have then the personal exemption, which we've not had personal exemption since 2017. So those will come back. into play. The child tax credit, which was double from the previous law, that also is going to go back to what it was before. And then one good news for clients that live in states that have either a high state income tax or a high property tax. Currently, that there's a cap on your ability to deduct those as an itemized deduction. The sum, whatever your state property and state income tax is, you're limited to $10,000. If depending on your filing status, deduct that ceiling will go away in January of 2026. So that's good news for those who have been limited by that $10,000 ceiling. A couple other deductions real quickly. The popular 20% qualified business income tax deduction that's deductible against business income. That's been very valuable to a lot of clients over the last several years. That will go away. And then, like I mentioned, the estate tax exemption will go back down to the 5 million index for inflation for individuals. So there's, if the law does not change, there will be a significant amount of estate planning and gift tax planning probably done in 2020 or 2025, if not sooner, leading up to that possible reduction in the exemption. So let's move to next steps and talk a little bit about how we might be able to help you or work with you. So we have a model in our firm. We call it the strategic wealth system. It really starts at the bottom, somewhat like the Maslow's hierarchy of need, where one of the first things we try to tackle for our clients is to minimize legally all of the tax that they are burdened with. So our goal is to create a tax plan that implements strategies that they can implement to reduce the amount of tax they have and create more wealth for themselves. That generally transitions over to helping them stay in better control of their money, to where they know how to grow their wealth, and then ultimately reach that finish line of financial independence sooner than they otherwise would. If you haven't already read or received a copy of our latest book called The Richest Doctor, it's a parable of 4 physicians as they embark on a journey of financial independence. Lindsay or Angie will talk a little bit about that in a second. And then just real quickly before I turn it back to Angie, our process basically starts with what we call a strategic blueprint. That's where we go in and we gather information, do a projection over the next 3 to 5 years of how we can help save taxes, and articulate that in a tax projection. If a client likes what he sees, they can choose to move forward. We have an onboarding and implementation of those tax strategies, and then we move into what we call a quarterly pulse, which is every 90 days. We're proactively looking through the windshield of where our clients are going to come up with as many additional tax planning ideas and recommendations as we can. On top of that, as a CPA firm, we also are dealing with the tax return compliance piece of it, but most of our focus during the year is on the planning side. So Angie, why don't you tell us about how we might be able to get started?
Thank you, David. And just a quick reminder, there is still time to submit your questions if anyone has them. We will talk about them at the end of the slides. So your next question is probably how to get started with tax planning and implementation. One way is to meet with me for a 30-minute introductory call, so we can discuss your current situation, and I can tell you a little bit more about our firm. You can find my contact information for scheduling on our website. One of the fastest ways, though, if you are ready to get started with your strategic tax blueprint, you can also go to our website and purchase that with the starter kit link, and then we can get started for you rather quickly.
And Angie, why don't you tell everyone the 2 websites that they can go to, or if you want to put it in the chat.
Okay, I'll put it in the chat. Okay,
thank you.
And then it's hard to believe, but we are coming up on our 1-year anniversary of The Richest Doctor. It has been #1 release in taxation and personal taxation categories on Amazon. And we do have some special offers for everyone that's on the webinar today. You can go on our website, therichestdoctor.com, and download the first 2 chapters for free. And then we also have a couple of specials with the paperback and hardcover as well, if you're interested. It's a really great book. I think a lot of our clients have really enjoyed it.
Yes, especially if it's now a bestseller.
Exactly. So we do have one question, David, if you're ready.
I'm ready.
We have someone that wants to know, what is the 401k limit for employers using the match for student loan payments? i.e., if I pay 60,000 on student loans, can my business contribute 60,000 as a match to my 401k, or do they cap? Does the cap still apply?
So it's the same cap that applies if you are deferring actual salary. So that this year, last year it was 20,500. This year it's 22,500.
Please. I think that was our only question today. You must have covered everything really well.
Well, there's usually questions after somebody has a chance to think about them, but anyway, we'd love the opportunity to work with you if you don't already have a tax planning firm you're working with. Again, you can read the testimonials from several of our clients there on the richestdoctor.com website that were a lot of our clients that have worked with us over the years. Again, I want to thank everyone for joining us today. We'll have hopefully an update later this spring or in the summer on any new tax law changes that are happening. And in the meantime, hope everyone has a great spring, and we look forward to hearing from you.